we've kind of changed the name on it because I feel like there's so many outdated information out there around this program and what used to be the way that this program or a bridge loan was done. There are so many different ways that we can structure this now that I just think it's really important in this market. There are a lot of people sitting on the sideline with a 3 to 4% interest rate that Amber, are you recording?
Yes, I am.
Okay, sorry. um, that would love to do something, but have a property they need to sell. And so this could be a really great way for you to drum up business, help more people, provide solutions. And so that's what we're going to cover here. So the buy before you sell program used to be also known or still is known as the bridge. We'll cover a couple different options of how this can be done and different ways that we are structuring this with our customers today. So why would somebody need a buy before you sell or a bridge loan? So common scenarios, obviously, it solves two problems. One would be needing money from the house they're going to sell for the down payment and closing cost on the new house. They don't qualify with two homes. So those are the two biggest pieces that the bridge loaner solves, is needing the money for down payment and closing costs before actually selling. And also the fact that a lot of people cannot qualify for two homes at one time. So that's the solution that, it fixes, but it also helps people find and get into their new home before having to sell, having to align. As you all know very well, it's very hard to align the buy and sell on the same day. The stars have to align. Not that it can't be done, but it is harder to get done to do it that way. A lot more stress, a lot more moving parts, avoiding storage, housing and storage issues. If you haven't, if you get your house sold and you haven't found the new place. The other huge thing that we're seeing right now is avoiding the contingency. So to go in contingent on the sale of your home, and a lot of times we're seeing some of these homes aren't even on the market yet. So they're wanting to be contingent. The house that they need to sell is not even on the market because they don't know if it'll sell too fast and they won't have somewhere to go. So now the chances of you getting that offer accepted are even slimmer. Not to say that people aren't taking the contingencies, but you're really putting, as a listing agent, your seller at risk by taking the contingency, and then your buyer agent, if you're doing contingency, you're putting your buyer at risk because you have no idea if your house will, if that house is actually going to sell. So these are all really good reasons as to why you should have some conversations with your sellers or buyers about a bridge scenario. And I think it's really wise to call it, a solution that allows them to buy before they sell. Because again, like the reverse mortgage, there are really a lot of people that either A, don't know what a bridge loan is, or B, there's some negative thoughts around what a bridge loan is, just from old times of how it used to be done. It might have been more costly. The rate on the first mortgage might have been higher, all sorts of things. So we're basically giving you an option to help somebody sell a home and solve a transition problem. So bridge loans create flexibility for buyers and sellers. And so one of the big things that it also helps with is getting their house sold faster. So we pulled some of these statistics to show that getting somebody out of the house that they need to sell, again, you guys all know this very well, getting it spruced up, getting the decluttered, getting all of the things that your sellers have that they've been living in their house for 20 years because they've just been there forever, and the house looks jam-packed, or it's just way too much. It's hard for people to envision themselves there. The bridge loan also can help get your house sold faster as you're listing it. So we thought that this was important because sometimes we come across sellers who or buyers or sellers who are resistant to using this type of solution, but these are things that you can talk to. So basically, if you get your house and you get out of your house and you get it spruced up, or you get all your stuff out and it shows better, your house will sell faster. So while there may be some fees that we will talk about with this program, you're on the side of being able to get the house sold faster. So this is important. I think that's just very important to know that these statistics are out there and they're actually real and true. So the other thing that we can talk to is a guaranteed backup contract. So we have one solution, and we're going to go into the bridge loan and how it works in just a second. But I want you to also know that this solution exists. So I do actually come across buyers who have sellers who need to buy, who have funds for the down payment. They just can't qualify for two homes. And we have a solution that is a guaranteed backup contract. So in this solution, all our bridge company is doing is saying at the end of 6 months, they are guaranteeing that we will buy this house from that seller, therefore removing us the requirement as the lender to count the debt for them. So I'm doing one right now where the borrowers have the money for their down payment. The equity is not the issue. The funds for closing is not the issue. They just can't qualify for two homes. So we're looking at a guaranteed backup where all they're going to do is pay $2,500 to guarantee that in 6 months, if the house doesn't sell, the bridge company will come in and buy this property from them. So that's another solution. And that's why I say it's not a one size fits all. We really dive in and we're going to determine what's the issue and what's the best way to solve for it and present solutions from there. So let's talk about the types of loans that this can be used for. Bridge loans, buy before you sell programs can be used on a conventional loan and a VA loan. Most people don't know that it can be used with VA. Cannot go on FHA, can't go with your non-QM programs, but basically these two investors, conventional Fannie Mae, Freddie Mac, and the VA, have said, if you have a guaranteed backup contract in place, which is what a bridge loan is, that at the end of 6 months, the bridge company will buy the property if it hasn't sold, that we are allowed to exclude the debt for that property. That's basically what the guidelines allow for, and that's why these programs make it eligible for their loans. Now, when we do these new loans, when we do a conventional loan for the new purchase or a VA loan, there is absolutely nothing different about that loan. We're running it the same way we would run any other conventional loan, and running it the same way we would run any other VA loan. Those rates also are the exact same. There's no additional fees on those programs. They look exactly like they would if we didn't have a bridge loan going along with it. So that's very important to know, because that is a really huge misconception, is that the first mortgage for the new house is going to have a higher interest rate, and it won't. So that's important to note. Let's go through how the calculation works. So basically what we're going to look at is we're going to look at what the value of the home is that they need to sell. So if the house is valued at $500,000, our example below, and they owe $250,000, we're going to estimate it's basically like it's typically around a 70% amount that we can use. So we can take 500,000 times 70%, back out the first mortgage, and that's going to be roughly the amount that we can use. Now, a couple things to note on that. We don't go to 100% because we need to have room in case there's price drops. That's why it's a 70%. We can also do this if a home is owned free and clear. So if they don't have a mortgage, we can do the bridge loan. The only thing we can't do is pull the full amount of money and pay cash for the new house. This bridge has to go with a new mortgage. So we have other solutions for that, and we'll talk about that in a second. But this is strictly if we're getting a new mortgage. So we can do it if they own the home free and clear, and we can still access the equity. We can't just use that money and pay cash for the new property. So we can also pay off debt. So if they're purchasing a new property, again, I have another one right now, we're going to pay off about $100,000 of installment loans at closing with the bridge loan funds, and basically do what they were going to do when they sell ahead of time. So they were going to pay off debt. We're going to do that with our closing to help qualify them, and then give them the rest of the money for the down payment and closing cost. So basically all we're doing is a simultaneous loan at the same time. We're doing their new mortgage, which is a conventional or a VA loan to purchase the property. And we're doing a quick cash out alongside of it to get the access for the funds that we need for the down payment and closing costs. And then we're doing a backup contract to guarantee that in 6 months, that debt will be offloaded from our borrowers. Now, a couple other things to note. We have scenarios where we can actually pay off their mortgage balance. Like, so for in this scenario, 250,000, we can actually use the bridge and pay off their $250,000 mortgage. Therefore, they have no mortgage payment. That is the biggest question we get is, I can't pay for two houses at the same time. Awesome. You don't have to. The bridge is going to help cover your mortgage payment on the house that you're selling. And then you're just going to have your new mortgage payment on the house that you're buying. And the way that we do that is the interest on that $250,000 is deferred. So there's a lot of calculations that go into it, but basically we are adding the deferred interest for what that balance is, and it's just paid off when they actually sell the home. So what happens at the end of 6 months if we haven't sold the home? That's also the biggest question we get. So the bridge company is going to purchase the home from them at whatever the contract is that's listed on the guaranteed backup contract. Now, that is also a very conservative number. Let's point that out. It's a conservative number because the bridge company is not in the business to buy homes. They do not want to buy your customer's home. They don't want to own it. They don't want a portfolio of homes. Their goal, they're making their money off the fees, and their goal is for you to sell that home. So they're going to want to see you guys, doing some price drops along the way. There's no like requirement on the price drops, but obviously your goal is to get the home sold within 6 months. And they don't really purchase many of these homes, although the market's changing a little bit. But basically, if you're going to do the price drops where you would normally do to get the home sold, then it's typically selling within the 6 months. If it does not, the bridge company is going to purchase the home at the end of the 6 months. They're going to relist it with you as the agent. So you still retain the listing. They're going to relist it at your suggested list price based on where the market is at that time. And when it's sold, anything that is profit that the seller would have gotten had they sold before the 6-month period still goes back to them minus fees and commissions. So the seller, while they see that really low number on the guaranteed backup contract for the 6 months that they, at the end of 6 months, that what they're going to buy it for, they still have the ability to walk away at the end of the entire process with their extra equity. The bridge company does not keep that money from them when you sell it after that 6-month period. Again, we're not seeing a ton of common times where it's not selling at 6 months, but it obviously can happen. So let's go into why we would maybe choose something over the bridge loan. And that's that scenario where and it could be either they own the home free and clear, or it just makes more sense. So we also have a very quick home equity line of credit that we can close in. I think we're closing one in like 5 days this week. Crazy. And it's electronic value. Everything's very electronic, so we can close them really quick. To use this solution as a bridge loan, the house cannot be on the market. That is a big piece to whether the HELOC is an option or not. The other big piece to the HELOC is we're going to basically give them the access they need to the equity of their home, but they still have to qualify for 2 homes. Okay, so they can't, with the bridge, you get to not count the departing residents in the debt ratios. With the HELOC, it may be a quicker, cheaper solution, but we still have to account for both homes and their debt ratios. And this is the solution that we use typically when they want to pay cash. So like I have a gentleman right now, he's doing a HELOC, he's using that money, he's going to pay cash for his new property. So again, every situation's different. What fits everybody's going to look differently, but that's what we're here for, to help determine what the best option is. It provides a lot of flexibility. We close these very fast. And again, it's a little bit cheaper of an option than the bridge loan might be, just based on, what the fees look like. The house also can be sold immediately after they get the HELOC. There is no prepayment penalty on our HELOCs. So it's a great short-term solution for this scenario. Okay, so what is the opportunity for you guys as agents, and how do you use this to win more listings? So common questions like, where would we go if we got our house sold? Can we use our equity? What if we can't find something? You can solve for that by having the solution of the bridge loan or a HELOC, or whichever case is going to work best for them. So knowing about these really gives you the information and the way that you can respond to the customer based on, or the seller based on, think something. I mean, again, I would say it's shocking to me, but I'm still coming across 75% of agents and consumers that just don't know that these options exist. So don't assume that they know that this is something that they could do, because they likely don't. And that's where you can come in to educate them. So what is the convenience? So I like to call the fee structure on these a convenience fee. Okay. Now that's just maybe because I've come up with a way of positioning it in a different way, but remember, there is a benefit to them. There is a convenience for them to be able to buy a home and sell after. That is a huge convenience. It comes with a lot less stress, getting the home that they really want, because if they're up against multiple offers and they have a contingency to sell, their chances of getting the home are less likely. They're going to win in the offer because they aren't contingent. You don't have to let the buyer or the seller of the property you're buying even know that they have a house to sell, because we've waived the contingency with our program. And it avoids them having to move twice, storage costs, all the things, holding costs for a property after they purchase, all those things. So if you yourself look at the fee in a little bit different of a light, you can probably position it better for your customer. And again, I call it a convenience fee. Is it do people want to pay an extra maybe 2% of what they're going to take out of their house? So basically the fee looks like this. It's 2% of whatever they're pulling out of their house. So if they're pulling $100,000 or $200,000, it's going to be 2% of that amount. But if they have a house that checks every single box, or they're in a situation where they've got 7 cats and 9 dogs, and having the house shown while they're in it doesn't make sense, this is a great solution for them. So it's all about how you position it and how you help them see, and we help them see what it's accomplishing by using this type of program. So let's go on. How do we overcome objections? I don't want to pay for 2 homes. There are programs that will allow you to only pay your new mortgage for your new property. And again, we want you to come up with a way just to get them to us. I don't need you to be an expert in how this works and what the fee structure is, and the ins and outs of this program. We need you to be able to identify the opportunities, get them interested in a conversation. And I'm happy if you want to be a part of that next conversation, but those conversations are things that we can help determine which is an option for them. They need to have a decent equity position. So if you're a seller and they just bought last year and they're trying to sell now and they didn't put any money down, they probably are not a candidate for this. I would probably call, let's have you and I have a conversation about it before you bring up this awesome program that they aren't going to qualify for. So it's not for everybody, but the ones that do fit this box, you need to just be able to know how you can structure an objection, the objection, to be able to get them to have that conversation with us. The fee seems expensive compared to losing your dream home, or moving twice, or storage costs, temporary housing, or missing the appreciation of the new property. Most clients see the value really quickly. So yes, there is some additional cost to doing this, but it will allow you to long-term accomplish your goals in a much less stressful manner. So just a couple ways that you can overcome that. Again, the people who we use this program with, they understand that their convenience, there's a cost to having convenience. And so there are some people that a small percentage of people that choose to not use it, but most of the people that are coming to use this situation understand, the reason that the fee exists. So how can you use this program to market? So connecting with past clients, we love the database for this. So we need to sell before you buy. If you have people that you talked to even a couple years ago that are at that, 3 and 4%, 2 to 4% interest rate range, those are great people to talk about this with, because they have a house to sell. They feel stuck in the sense that they've got a really low interest rate. And let's find a way to put a package together to get them into their new home, whether it's moving up up, moving down, whatever the case may be, to get them what they need. So a lot of times what we're doing with those scenarios with people that have super low interest rates is we're structuring the offer on the new house with maybe some seller concession to get the rate into maybe the low fives. And so therefore going from 3.5 or 4% to 5% doesn't feel as bad as going from 3.5 or 4% to 7%. So a lot of different, it's all about the strategy, and that's what we love. So that's where we really want to collaborate with you on that. So using this as part of a listing appointment, especially if you know somebody's selling and they're going to be a buyer, making sure you have this in your listing presentation or your buyer's consultations. We've got marketing and collateral that can be co-branded for you to have in those presentations. At every open house or every listing that you have, you should have some sort of marketing around this program. Again, don't assume that people know that this exists. I would say 50 to 70% of the buyers that put an offer on your listings that are contingent on the sale of the home don't realize that there may be these options. So being able to come back and saying, you know, I appreciate the offer, I see it's contingent. Have they considered a solution like this to be able to put your seller not in a risk of having that contingency? Listing agents should know that this exists before rejecting offers for your sellers, and then counter back about bridge options or buy before you sell programs. And then also helps sellers avoid temporary housing storage and double moves. So having those conversations. We've got campaigns we've put together that you can put out to your database. So you can base it, and we're not on it. So like, we're not part of that. It's just some material that you can use to educate your database. The one campaign has 3 emails and a video that you can use. And really, it's just about getting out there, social media templates that we can give you, social media scripts that we can give you to be able to talk to this. It's all about the education and letting people know that these types of solutions exist. Those conversations will lead you to more opportunities. So I will pause here, stop here, and we can open it up for questions. I can get this deck out to you, but I think also most importantly, get you co-branded marketing if you'd like that. So just let us know. And then, yeah, let's open it up for questions, and I can answer any questions you guys have. And if you don't have questions, it's because I did such a great job. No, I'm just kidding.
I do have one question.
Yes.
If I may.
Yes.
Is this, are these programs strictly for sellers in the state of Florida?
No, fantastic question. You can be, and very important again with the strategies that you may have, like groups, like there's so many groups out there, like moving from California to Florida. So this can be used with any state. So if you have a seller moving from Ohio, Kansas, Alaska, I don't know about Alaska, I'm throwing Alaska out there, but California, any property that they need to sell, this can be used for.
That's
The
fantastic.
purchase, yeah, the purchase is and we need to be licensed in the state that we're in, and you guys are, you know, this is all Florida, I think. So the purchase needs to be obviously in Florida, but when it comes to the house they're selling or the house that we're pulling money out of, it can be anywhere.
Thank you. That's great.
Yes. Any other questions? Anybody have any other questions I can answer? Well, I hope you learned something new, or I debunked a myth that you might have thought about some of these programs. We are happy to collaborate and review scenarios. Before you even talk to a customer, we're happy to run through what it might look like. Is it an option? The more information you have, obviously, the better for us to really, you know, run the numbers and so forth. But if you would like any of these campaigns or marketing materials around any of these things, let us know. We just love the opportunity to be able to collaborate and come up with options. Again, not everybody fits in one particular bucket, and that's what this is all about. So thank you so much for coming. We'll get this out, and I hope you all have a great rest of your week.